All right, let's call the meeting to order here of the JRIB 7:01 p.m. on October 27th. Hi, everyone. Hope you all are well. Good to see you. Sorry we're not in person. It was a last minute shift, but we had to do what we had to do. Brian, hopefully, sorry we caught you while you were on the train. And
No worries. Still good to be back up in Connecticut.
well, welcome.
I'm here. I'm on the second floor.
Oh, Walter, you're here, man. Well, sometimes things just happen.
No worries.
Well, let's get the show on the road. All right, everybody. Let's kick this off. If you would take a moment, please, to review the minutes from the September 22nd meeting. If you haven't already, I'll give everyone a couple moments. And then if someone is ready, if you'd like to please make a motion.
Carolyn, my only comment was that Mesro is misspelled in there a couple times.
Or we can adjust the spelling. Okay. All right, may I have a motion to approve the minutes, please?
And I just
Yep.
do I wait till you're voting? I abstained because I wasn't at this meeting.
Oh, yeah, wait till we vote. When we vote, Jesse, if you weren't at the meeting, absolutely abstain,
Thank you.
as we
I'll make
generally
the
do.
motion, Carolyn, to approve the minutes.
All right, Jack's made the motion. May I have a second?
I'll second.
Thank you, Tom. Okay. Any additional discussion? All right, all in favor of passing the moments, please say hi. Aye, raise your hand.
Aye.
Aye.
Opposed? And abstain? Brenda? Anyone else to abstain? Walter? All right, there we go. Thank you. All right, let's move along. We're going to move right into a performance review. Brian, I'm going to turn it over to you. I'm guessing are you able to share your screen, or do you?
I'm still not able to, or are you, is there someone else able to pull it up? Or does everyone have it?
Yeah.
You want me to share?
Thanks,
I
Tom.
can do it.
Thanks, Jared.
Thanks, Jared.
So while that's coming up, I'll just maybe kick it off. Carolyn, does that sound good?
Yeah, please.
Okay, yeah, I'm joined by my colleague Brian Scott. So good to see everyone virtually. Just we'll have a fairly brief recap, I suppose. So, of course, we welcome all and any questions, but we'll just review performance of the markets and, of course, both portfolios as of the third quarter. Last time, we're just moving past the fiscal year, but we could look at 1 year numbers on a calendar year basis as well. The only thing that's a little bit different that I put in, it's just one slide on the principal enhanced property fund. And I included that one slide to make the JRIB aware of that the principal had what I'll call loosened the investment constraints around the portfolio. I don't think anything unduly so. They just needed or wanted more flexibility the way the real estate market is developing. So again, I'll touch on that in just a moment, and then Carolyn or I can just give a quick update where we are with private equities. Does that sound good?
Yep.
Okay. Good. Again, jump in anytime, but let me I'll turn it over to Brian Scott, and he'll just review the markets for the quarter and year to date. This is just of the markets, not the portfolio yet.
Thanks, Brian, and good evening, everyone. So I'll get started on page 4 of the PDF. The third quarter of 2021 was rough, a bumpy road for equity markets. So we had a lot of headline risk appearing, whether it be inflation, news out of China, the debt ceiling. So if you look at U.S. markets, we were down slightly, about 10 basis points, and non-U.S. stocks down 2.5% for the 3-month period ending September 30th. U.S. bonds were roughly flat, and that goes the same for non-U.S. bonds. Can we go forward one page, please, Jared? On the next page on slide 4, we break out returns. On the left-hand side, it's U.S. equities by factors, so large, mid, small, value, and growth. But I think the interesting piece here is on the to the right of that, the non-US equities. So in your portfolio, you hold the total international stock market. Within that fund, it's made up about 80% developed markets and 20% emerging markets. Within the EM section of the portfolio, China makes up about 10% of the overall assets within the total international stock market. And with the headlines coming out of China, whether it be Evergrande defaulting on securities and China moving away from real estate leveraged economy, or from the tech sector limiting hours on internet securities, internet games for children, we saw a pullback in the Chinese market, and you can see that in the emerging market section with returns of negative 6.4% for the third quarter. So not a huge piece of the portfolio, but we do have about call it 2% exposure to the overall to China in the overall portfolio. So just want to make you aware of that, and we are monitoring it at Vanguard, but no concerns as of now. On the next slide, we break out returns by industry. So if you look at the one-year numbers, positive across the board for all 11 sectors. Just wanted to call out materials and industrials with all the labor shortages and rising prices. In the third quarter of 2021, we saw negative returns. So it's tough to pass along rising costs if you can't actually produce anything due to shortages, or whether that be labor or from material standpoint. So just wanted to bring that to the committee's attention. In the portfolio, we don't have any overweights to any one sector. Just thought it might be of interest. We can go forward one slide, please. From here, we take a look at the fixed income market. As I mentioned, roughly flat for 3 months ending September 30th. So treasuries, governments up about 10 basis points. In the investment grade space, flat. So even though rates were mixed, we have the spread factor in investment grades. So no return there. And then in high yield, we're still seeing spreads tighten, but in the portfolio, we do not have any exposure to high yield corporates at the time. Very quick overview. I guess one last thing on the fixed income front, I should mention, we did pull forward our forecast for when we expect the taper to begin. So we were in the camp that would happen in 2022, but given everything in the economy right now, and just the tea leaves from the Fed, we believe that's going to start later November, December. So we think it's going to be a 2021 tapering, or at least the announcement of taper, and that will commence in 2022. Any questions on the market recap before we move into the portfolio performance?
Nope.
All right, I'll hand
Okay.
it over to Brian. Yeah, thanks, Brian. So I'll focus on the 3 month and the 1 year numbers, because the 1 year numbers just give a longer time horizon, even though it's not your fiscal year. So with what Brian recapped as far as weakness in the equity markets in the third quarter, it's still been really strong year to date. So it just led to some muted returns for the 3 month time period. You'll see the portfolio is just up that 38 basis points, but it is over the benchmark return over, which was negative 31. That was really due to the alternatives that are in the portfolio, and I'll come to in just a moment. And that same strength is reflected in that 1 year number. Of course, you'll recall that we finished the fiscal year really strongly, but just looking at that 1 year number, still very strong, up over 20% and up close to 300 basis points over the benchmark. And again, it's really the private equity and the private real estate portfolio, that's our active management, that's helping it give the positive relative returns. Down below, where we show where the current asset allocation is versus our policy targets, and we're very close to all of those, slightly overweight to private equity given how well that's done over the last year. Just to again always give a recap, but we have about 2.5 roughly million go out of the portfolio every month. We use that cash flow to rebalance to those targets that you see on the page. We also have a lot of distributions that we're getting from our private equity partners, both in the quarter and the year. And so those are other cash that we use to rebalance the targets. And we try to stay always fully invested. Any cash that you see is just raising cash ahead of the month end. So,
Hey, Brian.
yeah.
Brian, in the September meeting, right, we voted to change the allocation slightly. Now, I would assume this is performance as of September 30th, so it probably does
Right.
not fully reflect the allocation change, or
It doesn't reflect the allocation change, and you're referring to the increase in private equity to 10%?
no, we did a slight decrease of equity, right, and slight increase of fixed income on the small.
Oh, okay, I have to review that. As far as the policy targets, Carolyn, maybe I'm missing that.
Yeah, we resubmitted the remember the policy targets as
Right.
part of the September meeting, and so the way that we increased the allocation to private equity,
Yes,
right?
from
And
5 to 10.
correct, right? And in so doing, we took down the allocation.
And then we brought down the equity allocation, the US and the international equities. That's correct. Yes. So we haven't made, we could reflect that at any time, including the next report. Of course, we haven't made those commitments yet, to the managers. All that paperwork, and we can come to that, is in progress. So I can look to the committee if you want the report to reflect that ahead of the actual commitments, or wait. And it'll just be a few months lag.
Yeah.
But I'm open to reflecting that on this performance report or not.
Why don't we do that going forward in
Okay.
October? Because the policy did change. The
Right.
policy allocations did change.
Okay. Yep, that's fair. And so I was just about to give, I talked about how much is coming out of the portfolio each month, but I also wanted to give the committee kind of a sense. I was looking at the year-to-date distributions and contributions to private equity on a year-to-date basis at the end of September. So we've had over 7.8 million in distributions. The private equity managers, Lexington and Mesero, returning capital. So 7.8 million, but there's still a couple of the funds calling capital. That was only 637. And that dovetails with our previous conversations that over time, the existing managers will run off. Right now, you see private equities over the target, or I should say the old target, but that'll change. And that's why we were committing to new funds. So nothing else on here, page 8. Page 9 goes into the actual fund performance. If you're able to scroll forward one. All right, great, thank you. As Brian alluded to, the two index funds on the equity side and the fixed income side follow the market returns that Brian already alluded to in the opening market section. And then as you scroll forward towards the bottom of the page, it starts to get into the private equity managers. But maybe what I'll do is just capture, when you see bold private equity, if you look at the quarter in aggregate, those 5 funds had performance of 11.8%. Now this is on a quarter lag, so this is as of second quarter. So 11.8% over the benchmark, which is the Russell 3000 index, plus a premium of 3% of 2.7. So big gain there, and that carries over. If you look at that 1-year time frame, in aggregate, those 5 funds delivered performance of 39%. Excuse me. I got to put on my readers here. 83%, and then the benchmark was 39%. So big outperformance from the private equity. Again, that's what would you consider active?
So
Yeah.
one second, if I could interrupt. So if I could just interject, right? What we don't have yet is the final fiscal year end performance numbers, right? Because the private equity results, right? We'll just be able to put them into the fiscal year end numbers.
Right. So these numbers here on this 9/30 performance report, as far as the private equity and the private real estate is concerned, it's always on a lag. So those are the performance numbers from the managers as of the second quarter.
Right.
But as far as your reporting, at your fiscal year, I think it would still go off that 6/30 performance report. Like we wouldn't carry these numbers over into the past fiscal year, I believe.
To show an actual at June 30, though, couldn't we take the September 30 numbers from PE and plug them into the June 30 number? Wouldn't that give an actual? Or no? To capture the lag?
Yeah. Well, I understand the question.
I believe that's what you
Going
did.
back and restating the 6/30 report. Is that what you're saying, Eric?
Revising. Yeah, making it, yeah.
Mhm.
I don't know what other communities do when you have a lag like this, whether it's in HF or whether it's in PE.
Yeah, it's typical throughout the industry as far as getting lag performance from any private equity, private real estate manager. As far as closing, the books on the fiscal year, my hunch is that you're still using that 6/30 performance report with their 1 quarter returns, and instead of going back and restating the performance report.
It'll be interesting to see how we end up doing that in the
Mhm.
GASB report. Right, because it was such a standout year performance wise, and for the fiscal year end, those are the numbers that will be rolled into the when the actuary begins doing their work. So
Yeah,
it
yeah,
makes a good year, makes a great year even greater if we
well,
could have.
that would be the case, sure, certainly. Yeah. So if you flip forward to the next page, we have the 5 private equity managers again in the third quarter, which was their second quarter. Those returns were anywhere from down 6% for one of the Lexington funds to up 17%. So wide dispersion. There are some differences of course, in the vintages. And that explains some of the performance. Some is 2013, some of these are 2017 funds. And then as a reminder, the Lexington funds just invest in secondaries, while the Mesereau is more of a, includes both primary, secondary, maybe I have to go back a little bit of co-investment, but they are different funds, so you'd expect different performance. As far as for the private real estate principal enhanced property fund, you see right in the middle, that was right on top of the benchmark, but real estate has been coming back with a lag as well, as far as you get more reopening of the economy and hotels start doing better, malls again. But so you see the benchmark, it was right over the benchmark, 3.9% versus 3.93. It's more when you look in that 1 year time horizon or further out that the principal fund has outperformed its benchmark. So you see the 9.4% on a 1 year basis versus the 8.02. So from an active management perspective, they've continued to deliver over the long term as well. So that explains, the relative outperformance at the quarter and then the 1 year time frame coming from those active parts of the privates. If you went forward to the OPEB plan, the performance was also muted, but with a negative number. You see for the 3 month or the third quarter down 0.55%. And as a reminder, a little bit more equity exposure there, a little bit more of a regressive posture versus the pension plan. So that's why you see more of a negative number versus a positive. It doesn't have the benefit of the private equity in the OPEB plan, but at least on a 1 year number, that 10% allocation to private real estate did help, and that explains the 1 year positive performance over the benchmark coming from the principal fund that I just reviewed. Don't really get cash flows into the in and out of the OPEB plan except when there's contributions. But they're still close to targets and within all the ranges. So to Carolyn's earlier point, this performance report doesn't reflect the new allocations that were voted on the last meeting. So with that, I thought it'd be a good time to go to the slide about the principal enhanced property fund. I know we had principal come in a few meetings ago, but as a recap to the JRIB, this fund is what's referred to as a core plus fund. I'll explain what that means. Is with core real estate, you're investing in that mainly from a income enhancement, over long periods of time in core real estate. And what I mean by core real estate, that's really stabilized income producing assets, existing buildings, whether it's multifamily office that are producing, rent and growth. When I say core plus, there's other segments of the real estate market referred to value add or development. Or opportunistic. So value add is, you you buy a building, you try to improve it and then get higher rents. So you're coming in and adding value to that existing property instead of it being up and running. And development or opportunistic is just what it is. You might just be buying land to build something on that. So the principal fund does allow up to 20% in value, in the value add or the development. It's only about 15% right now, or 14%. But I just wanted to give that as a construct of the fund. They look to produce about a 5% income or dividend on an annual basis, and that's one of their targets. So if you go forward a little bit to the private real estate page, here we go. So they wanted to enhance or to loosen their guidelines around the main sectors. I'll describe the main sectors in order to give themselves more flexibility to take, I'll call it bets away from the benchmark in order to add value if they don't like a particular segment of the market. So at the very top is you'll see their prior guidelines. And it says they had to have in the past a minimum 10% allocation to each of the 4 property types. The 4 property types are right below: multifamily, industrial, office buildings, and retail. Really jumping ahead on the retail side, I think that's a segment that they haven't liked for quite some time, and they wanted the ability to go further underweight where they are. So you see, coming back to the top of the page, their new guidelines is to have a 10% minimum in at least 3 of the 4 sectors. Retail, if you look at their allocation at the end of the second quarter, is about 10%. So it's approaching that minimum. If you look at the benchmark that's not represented on the page, retail makes up about 14% of the private real estate benchmark. So again, that's an asset class or a sub-asset class they've underweighted from quite some time, along with office, and that's what's led to some of their positive results. So they wanted that flexibility to, if they see other segments of the market, to invest in those and be more underweight retail or say office.
Do we have to vote on this, or
No,
are they entitled
no,
to make
those
this change within their? Is this within their purview to make the change and they just notify us, or is this something they have to request permission for?
they don't have to receive permission from all the investors. I did receive notification, Vanguard did. I don't know if who may be on the notification from the JRIB, if something's going to Caitlin or to Jared, but they do have to notify all of the investors, but they don't need a buy-in. They do have an advisory committee that did approve that, but I don't know, which I think includes some of their largest investors, but not all investors.
Well, thank you
Maybe
for bringing it to our attention.
Mhm.
It's probably a good decision on their part.
Yes, and and I kind of asked for some commentary around is this in line with other peers? If it was just a core fund, maybe it'd be considered a little bit more aggressive. But as far as other core plus real estate firms, it's very much in line. The other thing that I wanted to talk about is that other category you see at the bottom. So the real estate market, or the private real estate market, has been shifting as far as types of investments. And you'll see that on that last row of eligible property types. And the benchmark is also reflecting this, whereas in the past it didn't. So other includes investments in medical office or manufactured housing, senior housing. These are segments that are not necessarily captured in that multifamily or industrial, or what's referred to as those 4 major food groups. So now they have the ability to invest up to 20% in this other category, which again is pretty broad or many different segments. So the allocation as of the second quarter is 4.5%. If I gave you some context around, say, REITs, publicly traded real estate companies, if you looked at that benchmark, it's now about 40% or so in this other category. As data centers didn't exist probably in plethora as far as maybe 10 years ago, and same like other segments like manufactured housing or self-storage, those have just grown over the years. So I think the benchmark is evolving, and they're trying to evolve along with that, and again, to give themselves the flexibility if they don't like a particular segment to invest. So to your point, Carolyn, from a notification, I just wanted the JRIB to be aware of how those guidelines have changed. Curious, I mean, since you bring it up, Jared, I know you're online. Do you receive anything? Is anyone from the town receiving communication, to your knowledge, from principal? And I can make sure that someone does.
I don't remember receiving anything.
Okay.
I'll go back and look at my emails and I'll talk to Caitlin though. It would probably be either me or Caitlin on an off chance, maybe Connie, but I'll look at my emails again and also talk to Caitlin.
Yeah, and I don't mind checking in with them. So, Brian and I receive all updates from them, both performance reports or, guideline changes such as this. And so we'll bring it to the committee's attention, but probably makes sense just for someone else to get those notifications. So that's where I wanted to leave it. Nothing else to report except what I did before. We did get a flash report from them just this week. It doesn't have benchmark performance, but again, the private real estate market continues to do well. So, preliminary numbers for the third quarter for private real estate was up over 6%. So those aren't final; those will be reflected later. But it just shows how it's recovering with a lag versus the public markets. So Carolyn, I'll leave it there. I mean, we have an Outlook section that I can hit on. I don't know if you or I could just update the committee on where we are with the private equity documents. Would you like me to do that, or do you have a comment? Might be on mute.
Sorry, I'm afraid it's both of us at this point. Why don't we walk through the cash flow modeling that you did for the private equity, and then we can talk about where we're at with the subscription documents, with HarborVest, and where we're at in just engaging in some discussion about some of the points that were in those docs.
Okay, sure. So the modeling is still there. We updated it for any recent cash flows, but generally didn't change. The numbers didn't change dramatically, if materially at all, from the last meeting. But if you scroll forward a few pages, Jared, you'll see the cash flow modeling. This is reflecting a 10% commitment. And we don't want to get to that commitment right away. We want to diversify or lag into it so it shows commitments on an annual basis to get us to that 10% target over time. And just as a reminder, it does take a while to get there because you can make that commitment to a particular fund, but in the first few years, the private equity general partners are calling the capital, but you're not really seeing any returns in those first few years because they're just making the investments. And then later, in years 5, 6, 7, 8, and so on, is then you expect to see the return from those investments made in years, say, 1 through 4. So looking at the cash flow modeling, in order to build to that 10% allocation over time, in 2021, we were talking about an allocation or a new commitment of 30 million. That's at the very top. But that, again, this is assuming, as far as looking at the cash flow modeling and some of the other pages, make the assumption we made a conservative allocation that the overall portfolio would grow over like 4% a year, and we would hit that 10% target around the year 2024. Of course, it's an estimate, and that's forward 2 slides.
Right. And what we voted on, right? What we voted for was to initiate in our private equity allocation that we would split it evenly between HarborVest and Mesero.
Right.
Mesero is not currently raising a fund for 2021.
Right.
And so that leaves us with a decision, which leaves us just with HarborVest, right? But I can update you guys on where we're at with the subscription documents. There are some fine points there that we'd like to have just addressed and ironed out with HarborVest before we sign to the commitment. Most notably, there's as much, Brian, as we absolutely love working with you and Brian from Vanguard, there is fine print in there that says that, of course, our preferential fee structure is only in existence as long as we remain clients of Vanguard.
Mm-hmm.
And given the fact that the private equity investment commitment is a 15-year or so commitment, we'd like to know if there's some way to put some type of maximum exposure that we would be exposed to from a fee standpoint,
Right.
if we were to part ways with you at Vanguard.
Totally understand. I mean, I think that's those are all makes sense for the committee to have a grasp of that.
Right. There's another question to be raised, in that the HarborVest fund is based in the Caymans, and so we just want some clarity. Is this offshore funds? Is this, kind of what are we looking at with an offshore, with a Cayman vehicle?
Right. Quickly on that point is that there are 2 different type of funds. You could go towards an offshore fund, which is referred to a feeder fund, and it simplifies the tax reporting structure of how you just file. It would just be like one statement, as opposed to statements that might come through 20 different states, because the investments, the private equity investments, could be across, of course, across the country, in some cases the world. So there are 2 different funds to go into. Jared and I discussed that a little bit of which document that we could show. So the quick answer is there are 2 different funds, and it really comes down to a tax reporting preference. And then so we received all the questions. Thank you very much for sending those through. I can confirm that HarborVest now has all those questions, and we'll be drafting responses to each of them.
Okay. And when we get them in, we'll circulate them among the board.
Yep.
Jared, did you want to add anything on that? Nope.
No,
Okay.
I don't think so. We'll wait to get the responses, answers.
Okay. For me, it's a really important point on the fee exposure. I don't want to be on an unlimited fee exposed to a number in the future. So that's, to me, that's a particular sticking point.
Right. Yeah, no, it's a fair one to be cognizant of. Right. There's very preferential pricing, as it being part of the Vanguard HarborVest fund that we carry over. You're right. If you want to look 10 years down the road, who knows what could happen. If that relationship severs, then that fee to HarborVest can jump from that 21 basis points. I don't have the document in front of me, to around 60 basis points. I think that's still well below the industry average, maybe of 1% or so. but it's still a cognizant fact to be aware of.
Right. So we will circle back.
Yep, absolutely.
Jared, you can probably take down your screen. Does anyone have any comments or thoughts? Private equity piece. All right. All right. Thank you, Brian. Let's roll forward. Brian, did you have any, was there anything else? I think we're
No, I didn't have anything. I didn't have anything else. No,
thank you. Again, sorry to catch you mid-train ride.
not a problem. It's the world we live in these days.
All right, guys, let's kind of roll forward. Next item on our agenda is the discussion on the planned administrative services, and I'm wondering how our diligence team did with their work at exploring Milliman's offerings. Chris, Eric, thoughts?
Want me to go first, Eric? I don't care.
Sure, you go first, and then I'll capitalize on some of the concerns we have.
So thanks to Jared for organizing and getting us hooked up with Millman. Eric and I did a webinar with them. They walked us through the product. We talked about the administration and kind of the the process of how they would administer, how they would work with our people. I came away with it very impressed. I feel very confident. I think they would be able to offer some services that we don't currently have. Modernize what we have. I think they allayed any questions that I have in terms of their ability for service and getting getting what we would consider to be a robust solution for our membership. So it was a very positive experience in my mind. If Eric, you want to give your 2 cents?
Yeah, so the way I really look at what they can provide is they can provide 3 different things, right? A web porthole, a call center, and then some administrative function that basically is fulfilled currently with the benefits manager. This is not a system or a service that a lot of pension funds are using in the state. There's only currently 2 that are actively using it at different capacities. Stanford, one of the pension funds in Stanford are going to start using them at some capacity starting February 1st. So we'd like to do a little more due diligence on checking out who currently is using it and what that looks like. There is some forecasting of data. Not like that's something that you would do all that often, right? Like you get your pension statement once a year, and it's not something you really track because your benefit is defined. So it's not something you're really going to want or kind of check on. They did have it sounds like they have an ability where you could kind of bring in a third-party resource. So if you had a 457 plan with the town, that they may be able to bring in stuff from like ICMA RC. That's their old name. I forgot what they're called now. If ICMA would push that data out to them, that would be an interesting thing to do. I think that we just got to get some. I think we got to get some transparency on the cost. So the cost is rather high, and the reason why I put a high point on it is because we currently have a benefits manager in town, and I would assume maybe less than 10% of her workload is actually attributed to the pension fund, and this would almost be like 150% of her salary. So also it wasn't one of the things that we really bidded in the project. We looked for an actuary. So it almost feels like it's a late day upcharge to the current services that they're providing. That's just me speaking. That's the way it feels. I'd like to know, who else in the industry maybe does some of these services and what's some other pricing. And it sounds like there may be a little bit of an a la carte opportunity there to bring the price tag down. So we'd like to see some transparency on pricing. I think they were supposed to deliver that to us, and we didn't get that yet.
Oh no, I got it.
You got it. Did we get it? Yeah. So we got to.
I don't know if the general board has seen the price. Carolyn, have you seen the cost?
Nope.
Is this something we can discuss publicly, or?
I don't know. Probably.
Does it say anything on it, Chris, as far as confidential or?
Give me one
Probably
second
not.
here.
Right, I would
We,
assume we'd go into
I
executive
forwarded to you, I forwarded to you the email that came from them, from Milliman to Jim
Yep.
Hazelkamp. So you guys have that.
Yeah, I mean, I have it. You know, again, can we talk about it? I mean, I would just say this, I was a little surprised at the cost.
Okay, but we don't have a comparative analysis,
Right.
right? We don't know what market is, right? Let's be clear. We don't know what the market rate is for this. We don't know who else provides this service, and we don't know how to benchmark this service, right? And you know,
The other thing is we don't know how we're going to split the cost up between the two funds, right? So is it going to be a per capita basis? You know,
Right.
what would that pricing model look like? It is a 9-month onboarding process.
Right, that's true. That's one thing we learned. Yes.
You know, and it was a lot of us. Yeah, it was a lot of us voicing our concerns about, you know, what's the user interface going to look like? Is it going to be friendly? How's it going to affect the employee? You know, they talked about what the workflow is for retirement, and they would send you a package out, but it doesn't really make it easier because you still have to, you know, you still have to go to the benefits manager. So it doesn't eliminate steps. It actually adds another step for the employee to have to retire. It's one more person to have to deal with. So, like I said, it's nice. The user interface is going to be nice. The web portal is going to be nice. Again, I don't know how often someone's going to use it because it's a DB plan, and you know, it's just that's something we have to have. So if we can look at the a la carte pricing, and I think we should probably have them back at least one more time after we can compare some, you know, some competition. I think that it would probably, the due diligence of that would be it behoove the trusts.
The other thing too, though, is that they would, you know, they would take in all the calculations, they would back all that up. So, I mean, I do appreciate that aspect of it in that, you know, I would have, I think that I don't have the confidence in what we have now, but I know that they are going to be on demand and checking that and making sure that that is correct and timely. So, you know, whereas you get your yearly statement, you can log into this portal at any time and see the current, you know, your current allocation. So I thought that was something that I think our membership would benefit from. So, but again, like I said, cost is, again, we don't know what comparatively where it is, but even outside of a comparison, I was still surprised at the price. And you know, if this is the forum now or in the future to debate what our role is as a board in terms of, you know, these kind of hard costs and going forward, you know, what we feel is a reasonable amount of money to spend on this.
Yeah, I mean, if you're going to outsource something or privatize something, you're going to want to see a savings.
Right.
This all cost is coming back on us. So.
right, or you get superior functionality,
right,
and reporting, right?
Yep.
That wasn't available to you prior.
Well, they did say, again, I did talk about the reporting, and they did say they would work with us on any kind of reports that we would want, which was a nice change. So they are definitely very open and transparent on the reporting, and we would definitely work with them to get anything that we as a board would feel would make our jobs easier. And they would, you know, they would do the whole packaging too. You know, they would prepare the documents. You know, here are the retirements coming up. You know, we would be well in advance. We talked to the whole process of, you know, when someone initiates it, how does the board get communicated with? You know, are we getting these in a package? Are we getting it as they happen? So, you know, that's more in the details. But it was a kind of a soup to nuts package that, you know, and it's how much we want to engage with this process as well.
So can I ask a question? I don't know how you want to move forward with this. I can talk to Milliman about getting the a la carte pricing to see how granular they can get on that. Beyond that, as far as getting a comparison, I think when we got the proposals from all the companies, there was some aspect to that related to administrative costs. I don't know if we're ever going to get to a true apples to apples comparison given the differences in services, and I'll just reiterate what Jim Hazelkamp has been saying. We got to move quick on this. As you noted, this is a 9-month period to roll this out. We have short staff there now, and potentially, frankly, losing more within the next, I would say, 3 months. And so we got to move quickly on this. So I can get the a la carte. I'm not sure how much information we're going to get as far as comparing the services between different companies.
So I think if we can reach back, we'll reach back to Stanford, Manchester, and MDC, compare their pricing. Maybe we can do some comparison pricing per capita, make sure that at least we're in the same pricing zone. That could be something that, Chris and I can accomplish.
Right. And I think, remember, I think we had from the RFPs that we went out with the actuary, we did ask for capability in this area and how I don't remember if we included pricing in that. I'm pretty sure we did. Why wouldn't we have? We can dig that up. Why don't we dig up the comparative analysis spreadsheets?
Yeah, I wasn't on the original subcommittee, but I'd be happy to take a look at that too for comparison value.
Okay. And if it makes sense, if we want, whether or not we want to proceed, we want to put it back to the town, or we want to go out to an RFP. Right? We have all of those options available to us.
Yeah.
To me, the idea is, superior functionality, superior service, and something that hasn't been made available in the past to the pensioners is something we absolutely should consider bearing the cost of. We do kind of work for them, but I think diligence is going to be the key, right? So thank you for spending the time to looking at it. So I'm going to suggest that we go back to the well. We look at what we pulled in from the RFP process, understand what the pricing was, and if you could diligence out, please, those users who are currently using their service and get a sense of how that pricing works. I think that would be very, very valuable.
I mean, just on a general basis, what they gave us was, a kind of a maintenance monthly fee plus it's a per person or per participant fee. So every pensioner, there's a fee for everyone that they manage on a monthly basis. So, I mean, again, I don't know if I want to talk specifics, but I mean, it's
okay.
That's how that's how they do the pricing. It's basically, it's the per head cost.
All right, and Jared, if you could get a little more color from them of what a la carte might look like,
I'll do that. Yep.
See how sharp they can get their pencils, and come back to us.
Yep, will do.
All right, so Eric, you and Chris, do you mind kind of carrying the ball forward as you have been from here with Jared?
Absolutely.
No problem.
I wonder, Carolyn, does Vanguard as our OCIO, do they have any input on this? Do they have any ideas on what market rate should be? I'm not looking for an answer from Vanguard right now, but it certainly is another resource, and it's a huge company that probably has quite a bit of knowledge in this area, I would assume.
Brian, I think you magically reappeared.
Yeah, I don't have any insight on pricing. I could speak to some former colleagues, current colleagues. Years ago, Vanguard did or was in the pension administration business and made a decision to exit around 4 or so years ago. I mean, we still do custody, we still do pension payroll, but we don't do pension admin. So any of the data that we have as far as competitive pricing, I think would be stale. But I could still reach out to some folks that may have some insight there, either from our team of actuaries, and so I'll be glad to put that as a follow-up item.
Great.
It's usually the big actuarial firms like Milliman, like your Mercers, that have a pension admin business. So hope that helps a little bit.
Not to put Jared on the spot, do we know our current head count right now for people that are active participants and those drawing off the pension as a comparison? Was that in that pricing data, Chris?
In the pricing data, again, I have the per participant and then a total based on what our current, at the time of this was what the annual cost would be. So.
All right, cool. All right.
Yeah, I don't have that off the top of my head. No, sorry.
All right, Jared, Eric, Chris, you're still on duty. See what you can find. I think it was Gerald Foley who put together the comparative analysis spreadsheet for us for the RFP that incorporated a view about this service. Let's pull up and find those spreadsheets and see what the pricing looks like from that as a way to start. And we'll talk again about it at our next meeting. If you come to a conclusion sooner from your analysis, let us know. Let me know. We can, with 5 days notice, right? We can call a meeting. Understanding time is a sensitive part of this. All right, anyone have any other comments or thoughts on a way forward with this? All right, up we go. Jared, you're up. CFO report and kind of an update on the balance of the filing cap. Did we lose him?
For the CFO report, I'll report to you now that the appropriate transfers were made to be sure that the pensioners get their checks at the first of the month, and then I will be back next month with a quarterly report on both OPEB and pension and in the new format, and I plan to do that each quarter. And then Carolyn, what was the second part of your?
So you were going to do an initial assessment with Hazel Camp.
Yes. Okay. So there was a question that came up last meeting about the people who were entitled to some pension distribution who hadn't been given one. And this has been going on for years and years and years. And so they're still looking into it. I can say this, that they started attempting to send those payments out to people. And I'm trying to get a better handle on the numbers of people. My sense is that these are small amounts. These could have been, people who were there for a month or something, worked at the town for a month, and just I guess it never occurred to them to that they had some kind of contribution. And so I can't say this definitively, but I don't think these are large amounts, and I don't know the full number of people. But I'll come back to you again next month. As far as I did look at the statute. So depending on the amount, the value of the property that the pensioner would be entitled to, if it's over $3,000, it is determined to be abandoned after 3 years. And at that point, can be will escheat to the state, to the treasurer's office. I don't know if you guys are familiar with this, but the treasurer's office does the big list. I think they used to call, I don't know what they call it now, but they used to publish this list of different property, whether it's insurance or whatever the case may be, where you can go and claim it from the. So at some point that these payments would go to the treasurer's office. And so, like I said, for anything over $3,000, it would be after 3 years that it would be deemed to be abandoned, and it is 1 year for anything less than $3,000. So, depending on these amounts, we will work on getting these out to people and trying to determine whether or not they've actually been abandoned, or if these people can be contacted. For some of these, like I said, it's been years, so we don't know if we're going to be able to actually contact them.
I know there was some question last meeting about are we giving interest? Are we providing interest on these payments, and is that all calculated in there as well, or When does that stop? And I know again, I haven't seen the statute, so I don't know if we consulted a legal opinion on this in terms of, is it 3 years without, do we have an obligation to try and notify these people within that time frame and that kind of stuff? So that's my concern.
Right. Yeah, and I'd have to get more information about that, about the obligation to notify. And I know that Jim Hazelkamp was going to and is going to contact our pension attorney to get more details about it.
I mean, so I guess we're going to expect a report of just numbers, a number of individuals. I don't need, names, numbers, and
Yeah.
dollar figures. Okay.
Yeah.
Yep, it's underway.
Okay.
Okay, it's underway.
And age, a potential age, if that's possible in the report. Maybe the age of or a range of ages on how long some of this money's been sitting. I think that I would like to know that as well. If we have, 10% is over 5 years, 20% is over 10 years, that kind of thing, if possible. What kind of the distribution of time we've held on to these people's money.
I will see if we can get that.
I just have one question. When people leave employment, were they not told that they had this money? Were they offered to get it back and they decided to keep it there to get the interest?
So that's a
I can't speak to that because like I said, a lot of these were before even this administration. So I don't know what the practice was when, during that time period.
Because I just worry that it's not going to be, it shouldn't be considered abandoned if they were given the choice to leave it there and get the interest.
And to address what Susan said, we probably should come up with a policy sooner than later, so that when someone separates, what is the action moving forward? What is human resources doing to advise when an employee separates from employment and how that exit strategy is.
And I can speak to that because we're actually in the process of, because it wasn't done before this. We're in the process of putting together those, not just a separation policy, but an entry policy for employees as well, and what their there wasn't any good documentation or any good information or a process when new employees came in or when they left. And so we're, like a lot of things, we're starting from scratch again and putting together those policies so that we can, we'll be sure to get that information to them, what they're eligible for, what their options are if they have options in terms of pension.
Yeah, if I'm not mistaken, the thing that stood out to me on that was the last time that we had plan documents was in the mid 2000s. Hasn't been updated since 2006. I mean, it's been quite a while. So, I think it's a great point to include some policy around the separation. If I could kind of add a postscript to that, you guys are aware that the town has started a charter revision committee. Police and fire is in the charter. The police and fire pension is referenced in the charter. JRIB and the town employees is in the town code. I would ask if you'd like, particularly, if you're on police and fire, if you want to take a close look at what the charter reads and have any thoughts or concerns you want to send to the charter revision committee, this would be a great time to do it. I'm going to request that they look at the 5-day meeting notice requirement that we have and perhaps look to shorten that so we could call meetings a little quicker than 5 days. But heads up on that from police and fire.
Is there, I'm sorry to interject, is there a difference, or what's the main difference or benefit or disadvantage to being in the code versus the charter? Or is there any?
I
I don't think there's any. I mean, there's still the rules you have to follow. So I don't think it really matters. I mean, you know, Eric and I'll, you know, when we've been down this road with senior tax relief, it really doesn't, you know, you got to go through the gates, and the charters. A charter is a little bit more difficult to change than the code.
right. The meeting notice is in the code. It's not in the charter, but it's something I'd like to change anyway. But police, but it might have just something to do with the fact that it's relative age, right? That police and fire got involved in the last charter revision, and the town side wasn't there yet, and the JRIB may not have been formed, right? And so it's in the code. But this would be the time. I think they'll have it open for, I don't know, another month or two, and then they get to work.
I think they got quite a few gates to go through. This is going to be a process, not an event by any stretch of the imagination.
All right. Guys, that's all I have. I mean, that's kind of moved into some new business and out of the old business. It's a pretty short meeting tonight. Does anyone have any other new business or thing they want to pull forward? All right. Scott Pollock, you'll join us at the next meeting on December 1st. I know.
I will.
Well, I know. Wait, I don't have a November meeting. That is kind of the November meeting, and we can say our farewell then, or will this be our farewell with you?
If you want me to participate in December, I'm happy to do that.
Yeah, at least give us an opportunity to give you hopefully an in-person send-off.
Hey, it would be great to do an in-person meeting in December, because December's usually my Christmas party.
Yeah.
So I usually try to bring some soda and stuff. And if we have to change the location to maybe the fire training grounds, we can do that too.
If Eric's bringing candy, then I'll come to December for sure.
Oh, December's way above candy, my friend. We got A&S stuffed breads, and they come warm, and it's a good time.
And for the record, he said soda, not candy.
I think that was code.
Oh, that sounds good. All right, everybody. Then we'll see you on December 1st. Thank you, Scott, Eric, Jared, for pushing forward on the administrative front. And you guys, can I have a motion to adjourn? All right, so McCarthy, you got it. A second?
Eric Caliper, I'll second.
We're done. Thanks, guys. Have a nice night.
Good night.
Thank you.
Good night. Have a good one.
Good night.
Good night.